Hi, everybody. Welcome to the Parallel Systems broadcast. I'm your host, Mike, and a big thank you for joining me. On tonight's show, we are going to be talking about the bursting of the biggest bubble in history. The biggest bubble in history. You might be thinking, Mike, which one are we talking about? There is certainly a bubble in AI and tech, which looks to be popping right now. Thank you, Michael Burry. We'll come back to that one later. We've got a bubble in private credit. We've got a bubble in commercial bank debt. We've got a bubble in household debt. We've got a bubble in commercial real estate. In domestic real estate, there's bubbles everywhere, my friends. But right now, there are many cracks appearing simultaneously in the financial system. And I want to get into some of those in tonight's episode. So let's begin here. You might have heard of this. First Brands, the auto parts lenders, they've gone bankrupt. Now, in the bankruptcy, there has been some very seedy, sleazy dealings that have been revealed. And I want to discuss them because whilst these auto parts companies are certainly inconsequential in terms of the size of these bankruptcies, it's nothing compared to past bankruptcies in terms of Lehman Brothers and how consequential that was. But what we are finding out, what they're revealing, particularly now they're going into bankruptcy court, is that this private credit market has some massive skeletons in the closet. Recently, I said Nephilim-sized skeletons, and they're all about to fall out that closet. And I think what we're finding out with First Brands and Tricolor is that they are representative of a much greater and far more pervasive problem. And I think it bleeds out into AI too, which is something we need to discuss. But let's just listen or read what it says here. This is a Financial Times article. Utah's First Brands whale even leased the office furniture. It already sounds ludicrous, but wait till you hear this. It says, with fraud allegations and collateral disputes flying thick and fast, the corporate afterlife of, and they put this with a strike through, Frankenstein's monster of financialization. And that's really what you could use that to describe the entire financial system right now. It's a Frankenstein's monster of financialization. And no more is that true of tech and AI, which is just one giant fraud. But this is a fraud that's been unveiled. I think we're going to see that fraud revealed very shortly too. It says Ohio-based automotive parts maker has already thrown up questions that are less legal and more metaphysical in nature. Listen to this. Can you have security on an allegedly fabricated invoice? Because we're finding out that this First Brands has been fabricating invoices, triple, quadruple, who knows how many times, rehypothecating collateral that maybe just didn't even exist. It says here there was $2 billion worth of cash that was supposedly held in segregated accounts that simply vanished going into the bankruptcy. We saw this going into the bankruptcy of Lehman Brothers. In the weeks before it, hundreds of millions of pounds, I think it was $800 million of dollars, suddenly disappeared. And I think it ended up in JP Morgan's bank accounts, and they got taken to court, and this went on for years. This always happens. So when you are investing your money in a company, whether it's, I don't know, it could even be a gold vault, and they say, oh, we keep everything in segregated accounts. Yeah, that's not worth the paper it's written on, because I've done this research myself, and segregated accounts, what it actually means when they tell you it and what it looks like in reality can be two very separate things, because segregated accounts often is it's just another account held by the same entity. So it's not like a special account that they can't access. It's just like, no, we're going to put some money here and some money there, but they can still move money from one to the other. And if they're about to go bankrupt, well, you can see with First Brands, it just disappears into thin air. It also says, what if you finance thousands of windscreen wipers held in a warehouse in Mexico, but that collateral was then commingled with other lenders? Who owns the windscreen wipers? This is the kind of collateral that is being put up in private credit markets. There's an automotive parts lender or maker here. I don't know what First Brands do. I think they sell the stuff and then Tricolor finances stuff. But in any case, they were putting up piles of shitty, rusty windscreen wipers as collateral. Now, you might be thinking, how the hell was they getting away with this? Surely the ratings agencies would have stopped this. Well, not so fast, my friends. Apparently, the ratings agencies, there's a new crop of them, and they're behind the private credit boom. Now, private credit has exploded since 2020. And alongside that, we've had a massive growth in ratings agencies. And they have been working specifically with private credit. Now, you'll remember going into 2008, we had the mortgage-backed securities, and all of the credit agencies were in bed creating fraud, basically is what it was. They was allowing a genie working for minimum wage jobs to get 8 houses, and then there was packaging up that with other mortgages and other mortgages, putting them all in a bundle, rating them as A+. That's what was happening, and that's what enabled the bubble to go on. Well, the same thing is happening. Now, listen to this. It says this time it's not the 3 big agencies of Moody's, S&P, and Fitch that are in the line of fire, but second-tier shops that have shot to prominence by catering to the booming private credit market, which has grown to some $3 trillion in recent years. Smaller specialist providers such as Morningstar, DBRS, Kroll, Bond Rating Agency, HR, and Egan-Jones. Now, they are a snaky company. We'll come back to that in a second. Have seized market share by offering private capital groups the chance to shop around. Some of the biggest asset managers in the world, including Blackstone and Apollo, are amongst the most frequent users of these ratings agencies. So just think about that. These are the biggest asset managers in the world outside of BlackRock and Vanguard, and they're using these ratings agencies. So if these ratings agencies are failing, intentionally so, and marking companies that have SPV vehicles and all kinds of scams going on to get better ratings, and they're putting up fake collateral that isn't even there in the warehouse, or piles of rusty windscreen wipers, and it's being treated as though it's a pile of gold. Well, you can see how this could go wrong once this all starts to unwind. This is all absolutely fine and dandy when the liquidity is there and these companies are still able to refinance. But once those conditions tighten, and what did we have just recently? We had the repo market spike, just like it did in 2019, which precipitated the COVID crash, where they flooded the system with liquidity because tightening the Ponzi scheme never works, as we know. Well, in reverse, none of this works. In reverse, these are the companies that start to blow up. And when you've got the canaries in the coal mine blowing up, Jamie Dimon is correct. He said, when you see one cockroach, there's probably more. And I think that's what's happening. And the ratings agencies are, of course, in on it again. It says UBS chair Colm Kelleher warned last week that insurers shopping for better ratings on their private credit assets was creating a looming systemic risk. Well, I'd say that's an understatement. While Bank of England Governor Andrew Bailey said industry figures were sounding the alarm to him about the role of the ratings agencies. Now, he would know. He knows all about a Ponzi scheme because he's governor of the Bank of England. And it says, what we're seeing now is a massive growth in small rating agencies ticking the box for compliance of investment. And it discusses one particularly. I'll just give you a flavor of how these companies are working. This one's called Egan-Jones. They began issuing private credit ratings in 2014. They are behind 22,000 transactions. They've got just 20 or so analysts, and they're managing to issue more than 3,600 ratings last year alone. 20 analysts, 3,600 ratings. And they told the Financial Times it's issued already another 3,400 so far in 2025. Now, there's a lot of these companies. And that's essentially what they do all day. You've got somebody, remember on The Simpsons where Homer was in the nuclear power plant, and he got tired and he didn't want to do his job, so he just had that little ornament. It was a bed, and you pushed it and it just nodded and hit the keyboard. That's pretty much it. That's pretty much what the ratings agencies are doing. And there was an independent study on some of their ratings, and apparently the results were that bonds or debt, should I say, that they was rating B+ were actually coming out as C. So, yeah, that doesn't sound good to me. So let's talk a little bit about how they're managing to pull this off, because like I said, you've got these ratings agencies, this new crop that are there, and they're just pushing on through any old company that absolutely positively wouldn't be able to get credit in any other circumstance. These are companies that have poor collateral, fake collateral, no collateral in the warehouse. They've got dodgy invoices that are being conjured up out of nothing. They've got all kinds of tricks to try and get these companies looking credit worthy. For example, you've got collateralized loan obligations, similar to what was going on in 2008, but in private credit and corporations this time. They're bundling up these shitty companies that shouldn't be given credit, and then they're creating different tranches that you can invest in: AAA tranche, B tranche, equity tranche, and they're saying, look, we're going to spread the risk, guys, but the AAA tranche is probably a D for dog shit tranche, and nobody should be investing in it. And you can only imagine how bad they get as you go down through that hierarchy. And the other thing that they're doing as well is these things called SPVs, which is special purpose vehicles, I think they call it. And the SPV is where they essentially take a company like, let's say, First Brands, and they spin off a part of that company and create a new company. And then the main company puts some assets into this new shell company, and then they use that to get loans for the main company. Now, the problem with that, of course, is firstly, it's a form of fraud, really. You know, if you've got bankrupt old Joe, your Uncle Joe's bankrupt, and then you say, oh, okay, Joe, well, let's take some of your assets that are going to get swept up in the bankruptcy and we'll put it into Auntie Jones' account. And then Auntie Jones says, well, I'm good. And Auntie Jones taking loans out and giving them to broke Uncle Joe. It's not really legitimate, but they're allowed to do this, and that's what they've been doing.
But you gotta promise us, Uncle Joe, no more deception, no more games, no more lies. You promise?
I promise. Now come on, let's go.
So there's all kinds of fraud going on. Now, like I said, we don't know how bad this is, but I think there is a huge bubble there. And then you've also got the AI bubble that's starting to burst. And that's, of course, because we've got Michael Burry, who recently came out and said what we've all been saying for a long time. These valuations are insane. And I think this whole narrative that they've created about AI taking over the world, and you've got people like Peter Thiel coming out and saying, well, AI is going to build the Antichrist. And then you've got Sam Altman saying, yeah, soon AI is going to be everywhere. Nobody will be able to live without it. I'm not seeing that. Are you seeing that? Or do you think that these narratives have to get bigger and bigger to justify the projected earnings of these companies that keep getting bigger and bigger and bigger, when you've got essentially earnings going into the many trillions that don't exist, but they're promising us will exist? I think it's a scam. Now listen to Sam Altman.
With all that said, you know, OpenAI's revenues are still a reported $13 billion in 2025. And Sam, on your live stream this week, you talked about this massive commitment to compute, right? 1.4 trillion over the next 4 or 5 years with, you know, big commitments, 500 million to NVIDIA.
Big commitments, 500 million to NVIDIA.
300 million to AMD and Oracle, 250 billion to Azure. So I think the single biggest question I've heard all week and hanging over the market is how can the company with 13 billion in revenues make 1.4 trillion of spend commitments? You know, and you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. If you I just enough. Like, you know, people are. I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself. Including myself.
People who talk with a lot of like breathless concern about our compute stuff or whatever.
Now, let's just pause for a second there. Did you see how defensive he got when it was called out that, Sam, you've got, 10, 15 billion, whatever it is in revenue, and you're making forward prognostications of 1.5 trillion in spending. Where's the money coming from? You guys in AI have already sucked out all of this capital from the S&P 500. You've got crazy valuations, and now the piper has to be paid, because guess what? It's turning out that the world isn't obsessed with AI. It's not making us more productive. None of these guesswork on the cigarette packet calculations you guys have been giving us look like they could ever come to fruition. The only people that I see that are making money off AI is Substack writers who are using it to write shitty articles that they can't write for themselves, so they're getting ChatGPT to write it, and they're claiming that it's their research. That's the only people. Now, I'm sure there are some case uses for it in some certain specific industries, maybe in the legal profession, maybe in computer programming. But as far as I've been told from people in those industries, it makes way too many mistakes. In fact, it's costing them more trying to fix the mistakes that it's making than it would be to just not use it at all. And it reminds me a lot of the 2000.com bubble. In fact, you could even argue that this is the tail end of that bubble, because since 2000, all they've done is reflate the system again and again and again with bigger and bigger bubbles until we got to the sovereign debt bubble, which is precisely where we are now. But the same dynamics at play that was there with these telecommunications companies and these dodgy internet companies that had no real business, no profitability, but everyone believed the narrative, they believed the hype, and so they invested in them. And of course, what happened? It collapsed and tech went nowhere for a decade.
At some level, when something gets sufficiently huge, whether or not they are on paper, the federal government is kind of the insurer of last resort, as we've seen in various financial crises and insurance companies screwing things up. So I guess, given the magnitude of what I expect AI economic impact to look like, I do think the government ends up as like the insurer of last resort.
So there you have it, my friends. Sam Altman is already angling for a bailout, even though apparently AI is going to take over the world and the Antichrist will rise and it'll be Armageddon. That's how crazy good AI is going to be, didn't you know? But actually, why is he talking about a bailout and being too big to fail? I think that's the goal. It's like, quick guys, let's make ourselves as too big to fail as possible. In fact, let's take on as much debt as we can. Let's take on as much private credit. Let's make ourselves the most toxic, stinking swamp monster possible, so that when this all comes down, they have to bail us out. I think that is the strategy. That is actually the AI strategy with all of these companies, and that's why they're furnishing each other's balance sheets. Now, Michael Burry, like I said, I think he smells a rat, and let's have a look what he's been saying just today. He says, understanding depreciation by extending useful life of assets artificially boosts earnings. One of the more common frauds in the modern era. Massively ramping CapEx through purchase of NVIDIA chip servers on a 2 to 3 year product cycle should not result in the extension of useful lives of compute equipment. Yet this is exactly what all the hyperscalers have done. But by my estimates, they will understate depreciation by $176 billion between 2026 and 2028. By 2028, Oracle will overstate earnings by 26.9%, Meta 20.8%, and it gets worse. And he says more details coming in a few days. And like I said, the AI narrative is starting to fall apart, but there's many other cracks appearing simultaneously too. And we have a mega bubble super cycle because we've had 35 years of reflation. We've got quadrillions in derivatives. We've got so much hidden debt in the shadow banking sector. And also, look at the US debt now. Just look at how poor the creditors have actually become. We've got stablecoin companies who are becoming some of the largest holders of US debt, which, by the way, just a reminder, it's the base layer of the financial system. So it used to be other sovereign nations that would hold this debt. Well, they're getting rid of it and they're going to gold. Now it's shitty stablecoin companies that are based out of the Cayman Islands that are the biggest funders of the financial base layer, which is sovereign debt of the US. But it's even worse than that, because ahead of the stablecoin companies, they're doing their best to swallow up all of this debt. But ahead of them, also based out of the Cayman Islands, the largest holders of US treasuries are now hedge funds. Yes, you heard me right. Hedge funds doing the basis trade, leveraged at 50 to 100 times. And they are actually the largest purchasers of treasuries right now. And stablecoin companies are catching up. So just think about the drop in quality of creditor. So you've got the drop in the quality of the debtor, which is the US, which is, of course, falling off a cliff. And now you've got the drop in the quality of the creditor too, which doesn't fill me with confidence, and it shouldn't fill you with confidence either, because like I said, we've got so many simultaneous bubbles happening right now. We've got the mega bubble in sovereign debt. That super cycle, 35 plus years of reflation, it's coming to an end. You've got this reliance now on these really poor creditors who are all dodgy. None of them are being audited properly. If you look at the stablecoin companies, we've never seen a proper audit. They give these fake audits out. Tether, I'm looking at you. And now you've got the repo market stress. You've got the repo market stress telling us that liquidity is tightening. It's, of course, going to destroy commercial banks if we have a major blow up because their balance sheets are wrecked because of all of the unrealized losses. And now they say it's unrealized. It's never going to come to fruition. But we already saw that that can happen a few years ago with Signature Valley Bank. That if we see a run on these banks, they have to sell the long dated debt. That's all underwater. So the unrealized losses become realized losses. Now we're talking about this subprime credit bubble that looks bigger than ever, way worse than 2007 and 2008. The AI bubble's coming to an end. And I think the biggest change that we're seeing is not that we're learning about these bubbles. We all knew about these bubbles. But what it takes to pop the bubble is for investor psychology to change. And I think that's what's happening now. And the credit markets are flashing warning signs. Nobody wants to lend to each other. So what does it all mean? Well, I think it means that we're going to have to see a massive reflation. And if we don't, we're going to get to the greatest depression in history. So they're going to have to try and reflate. But what can that lead to? Well, it could lead to hyperinflation. And that's something that I think is actually terrifyingly close. Because if they do try and do this again and kick that can one more time, where do we get to? When you've got households with record credit card debt, record auto loan debt, everybody's choking on credit. And if you force more money into the system, and Donald Trump is talking about giving $2,000 dividend payments to the public, which is just stimmy checks again, it sounds to me like they're gearing up for another round of what they did in 2020. But if you get inflation above 50%, you usually go on to hyperinflation. Statistically speaking, if you look at the IMF's studies of past hyperinflations, it's around 50%. Now, I think last time some nations in the West got above 20, 25% true inflation. This time, I think we would get above 50%. So what does that tell you? Well, it tells me that we are heading towards some kind of end game. And of course, at some point, they're just going to have to reset the system. There is no way you can continue this game indefinitely. They seem to want to try, but I think they probably know it's impossible. So let's watch this space. I'd love to hear in the comment section what you think of all of the above. Thank you so much for listening. Take care of yourselves, and I will see you in the next one. Okay, my friends, just a quick addendum to the video. I don't normally do this, but just as I was about to release this video this morning, we found out that Michael Burry is actually now closing his hedge fund, Sion Capital. Very interesting because, of course, he shorted the markets. He revealed that he had big shorts on Palantir, big shorts on NVIDIA, and then the market got spooked because of it, and it's really impacted them. Today, the Nasdaq is down 2.5%, Palantir is down 6%, Bitcoin's under 100K. What happened to digital gold? Well, it's looking pretty hairy, and a lot of this has stemmed from the investor psychology changing, and Michael Burry was certainly the person who flipped that switch, in my opinion, because it happened just after his tweets. And now we're finding out that he's closing his hedge fund. So the question is, was he planning this all along? And did he want to reveal this information so the markets would hopefully move in his favor, which would be down, so he could exit quietly? Or has he been told that he has to close the fund? I don't know, because I imagine there's a consequence to being the man who pricks the biggest bubble in history. Now, like I said, they will try and reflate this bubble. They will always try and reflate it, or at least I think they will always try and reflate it. We don't know. We should never say never. As always, take care of yourselves. Thank you so much for listening, and I'll see you in the next one.